You'd think higher interest rates would make bonds more valuable. The exact opposite happens. A bond paying 3% can drop from $1,000 to $850 overnight when rates jump. This confuses millions of people watching their safe bond funds crater during Fed announcements. Here's why bonds exist in the first place. Governments and corporations need money now but can't pay it all back immediately. So they issue bonds, basically IOUs that say, "We'll pay you back in 10 years, plus we'll send you interest payments twice a year until then." That interest rate gets locked in the day the bond is created. A 2020 bond paying 3% will pay 3% forever, even if the world changes completely around it. A bond is a loan you give, packaged as a tradable asset. Face value means the amount printed on it, usually $1,000 for individual bonds. Coupon rate is the interest percentage that never changes. Yield is trickier. It's the annual return you actually get based on what you paid. If you buy that $1,000 bond for $900, you're still getting the same $30 yearly interest, but now your yield is higher because you paid less up front. Maturity date is when the borrower pays back the face value and the bond expires. Think of it like a rental agreement. You own an apartment lease that pays $3,000 a month. That contract is locked. If new leases in the building suddenly offer $5,000 a month for identical units, your lease loses value to anyone who might want to buy it from you. Not because your apartment got worse, because the market moved. Here's how the price-yield seesaw actually operates. Start with that new bond scenario. The Federal Reserve raises interest rates from 3% to 5%. Corporations and the Treasury immediately start issuing new bonds at 5% to match the market. Your existing bond, purchased a year ago, still pays its original 3% coupon. Both bonds have the same $1,000 face value. Both mature in 9 years. The only difference is the annual interest. Now you need cash and decide to sell. You list your bond for $1,000. A buyer looks at two options: your 3% bond for $1,000 or a fresh 5% bond for $1,000. Same risk level, same timeline, but one pays $50 a year in interest and yours pays $30. No rational buyer picks yours at equal price. So the market forces your bond's price down until the math works. Your bond might need to sell for around $850 to make that $30 annual payment competitive with new bonds. The buyer gets the same $1,000 back at maturity either way, but now they're buying in at a discount that compensates for the lower interest stream. The critical piece? The $30 coupon payment never changes. The bond certificate still says 3%. But yield, the actual return based on purchase price, adjusts instantly. If someone pays $850 for your bond and receives $30 a year, their yield climbs to about 3.5% from the interest alone, plus they capture the $150 price gain at maturity. The bond's yield rose because its price fell. That's the seesaw. They move in opposite directions automatically through market pricing. Example math to make it concrete. Original bond issued in 2020, $1,000 face value, 3% coupon, matures 2030. Pays $30 per year. Fed raises rates in 2024. New comparable bonds now issued at 5%, paying $50 per year. Your bond's market price drops to roughly $840. New buyer purchases at $840. They receive $30 annually for 6 remaining years. At maturity in 2030, they get $1,000 back. Total return includes interest plus price appreciation from $840 to $1,000. Their effective yield ends up near that 5% market rate. The price adjusted downward so the total return matched newer options. This happens in milliseconds across millions of bonds. When the Fed announces a rate hike, bond traders don't wait. Prices for existing bonds drop before the trading day ends. Bond mutual funds and ETFs recalculate their value every afternoon based on current market prices for all their holdings. That's why your 401k bond fund shows a loss on rate hike days, even though none of the bonds defaulted. 3 big misconceptions trip people up here. First, bonds are safe, so they can't lose value. Bonds issued by stable governments won't default, meaning you'll get your face value back at maturity. But market price between now and maturity absolutely swings with interest rates. If you bought a bond at $1,000 and rates spike, it might trade at $870 next week. You didn't lose the final $1,000 payout, but you did lose liquidity value. Second misconception: this only matters if I sell. True for individual bonds held to maturity. You ride out the price swings and collect face value at the end. But bond funds never mature. They hold hundreds of bonds with staggered dates and constantly trade them. The fund's share price reflects today's market value, so rate changes hit immediately. Third, rising rates are bad for everyone in bonds. They're bad if you already own bonds. They're great if you're about to buy. That $850 discounted bond is a deal for new buyers. Pension funds and retirees buying in 2024 love higher rates because they lock in better income streams. You'll see this principle show up in three big places. Bond fund values in retirement accounts drop during Fed tightening cycles. Headlines say, Treasury sell-off or bond rout when rates climb. That means prices fell and yields rose. Mortgage rates track the 10-year Treasury yield closely. When bond investors demand higher returns, mortgage lenders raise their rates. The 2022 jump from 3% to 7% mortgages happened because bond yields spiked, making home loans more expensive for the same reason. Old, low-rate promises lost value. Here's where the simple story gets complicated. Not all bonds react equally. A 30-year bond loses way more value than a 2-year bond when rates rise, because that locked-in low coupon rate hurts for decades versus just a couple years. That sensitivity has a name: duration. But the intuition is straightforward. Longer lockup equals bigger price swings. Corporate bonds with credit risk move differently than government bonds. If rates rise because the economy is booming, corporate bonds might hold value better because default risk drops. If rates rise to fight inflation, everything gets hammered. And bonds can trade above face value too. If you own a 6% bond from 2018 and rates fall to 2%, your bond becomes a hot commodity. Someone might pay $1,150 for it, because that 6% income is now rare and valuable. So here's what a bond actually is. It's a loan with a fixed interest rate that gets bought and sold in a live marketplace. Prices adjust every second so the returns stay competitive with whatever rates exist today. When rates climb, old bonds can't compete at full price, so they discount. When rates fall, old bonds with higher coupons become premium products. The bond itself doesn't know or care. It'll pay the same coupon and return the same face value no matter what the market does in between. The seesaw is just the market solving a math problem. How cheap does this bond need to be so its total return matches current alternatives? You're not getting robbed. You're watching supply and demand applied to debt instruments. The $1,000 you get at maturity is contractual. The price today reflects what someone else will pay to take over your position. That spread is the seesaw.